Hello and welcome to Tax Matters as the month of August 2023 winds down. Friday, September 1st is here. Take-off date for the various provisions contained in the Finance Act 2023. And to keep our viewers up to speed, we began last episode highlighting the provisions of the Act. Let's share with you some more.
Another provision that is significant, which has now been taken out, is the fact that income in convertible currency accruing to hotels from tourists, were hitherto exempted from tax. So when you generate funds from tourists by hotels in Nigeria, such funds were expected to be kept in a pool that the hotel owners can use to expand the hotel business so that they can attract more foreigners. But of course, if you already have a fund and you have made provision in those funds, you can still utilize them until the fund is fully exhausted, at least for the next 5 years. Another provision that came up in this act is the fact that upstream and midstream gas operation companies, are now to claim capital allowance like agricultural and manufacturing companies. That is, the restriction of capital allowance to 2/3 of assessable profit will not apply to them. It was just something that is necessary for clarification, to be sure that they also are to enjoy full capital allowance without any restriction. Again, there is a small provision under the personal income tax, which is the fact that premium on contract for deferred annuity, when you insure your life and the life of your wife, ordinarily there are available deduction from your salary in calculating your income, in calculating your personal income tax. So recently the provision around a contract for deferred annuity was removed, but it has now been reinstated. But the only restriction is the fact that when you pay premium to deferred annuity, you cannot withdraw it within 5 years. If you withdraw it, the relief will not be available. I think this is also good for the insurance industry particularly. Another significant provision that we have is the Petroleum Profit Tax Act. Certain changes were made to be able to align, the penalty regime in the PIA of 2020 with the existing Petroleum Profit Tax Act. There's also a specific provision on decommissioning cost, provision for decommissioning that was not allowed under the PPTA, but was allowed under the PIA. That has now been amended so that such provision for decommissioning and abandonment, will be available as a deduction for companies operating in the oil industry. Then for value-added tax, 4 provisions were actually introduced in the Finance Act. The first one is the anti-avoidance provision, where that relates to artificial or fictitious transaction. So what the law has said now is that where there are artificial or fictitious provision or transaction, that the tax authority can disregard such transaction and make necessary adjustments in order to counteract the artificial nature of the transaction, particularly where it relates to connected entity or when you talk about trust or grant. The second one is the power that has been given to FRS to appoint agent. That has been in the provision before now. But the specific provision that has been included in this particular Finance Act is the obligation of VAT collection agents, to file returns, by the 14th of the following month. So if any company has been designated as an agent of FRS for the purpose of withholding VAT, a reverse VAT on their payments, to their vendors, instead of paying the vendors and allowing the vendors to go and remit, most of whom don't remit because of the significant nature of those entities that have been appointed. And so such companies have now been given 2 obligations: to deduct VAT on the payment to their vendors and to also remit VAT on their own income. And then again, there is a redefinition of what constitutes a building or interest in land, okay? And that provision is to exclude radio and television masts, transmission lines, cell towers, vehicles, mobile homes, caravans, and trailers as not forming part of building. So which means transaction on those now will be fully liable to VAT. But of course, we know that VAT is no longer applicable when it comes to land and building and any form of interest in building, including rent.
There you are, Finance Act 2023. Effective date now 1st September 2023. You are still on to Tax Matters. The Presidential Committee on Fiscal Policy and Tax Reforms, which was inaugurated on Tuesday, 8th of August by President Bola Ahmed Tinubu, has started work. On Thursday, 24th August, members of the committee drawn from various sectors of the Nigerian economy came together for the inaugural meeting and workshop. To underscore the importance attached to the assignment, the newly sworn-in Minister of Finance and Coordinating Minister of the Economy, Mr. Wale Edun, was in attendance. Also in attendance were the Executive Chairman FIRS, Mr. Muhammad Nami, and the Special Advisor to the President on Revenue Matters, Mr. Zacchaeus Adedeji.
It is just about 16 days since you were formally inaugurated by Mr. President, and you know, and you heard directly from him how important this work that you are doing is. Because it is putting into action his vision, his commitment, the basis on which he won his mandate to lead this country. And quite simply, that is to lead the country to better times. In terms of the economy, growth that creates jobs and reduces poverty.
The minister gave this charge.
In terms of what we call the overall picture, the macroeconomic situation, what he has moved swiftly to start doing is putting in place the kind of stable environment in which investors can come in, the economy can grow. So, and the objective is to reduce unemployment. It is to reduce inflation. It is to have a stable exchange rate. And all those things put together will drive the economy to grow and reduce poverty at the end of the day.
Chairman of the Presidential Committee on Fiscal Policy and Tax Reforms, Mr. Taiwo Oyedele, began his presentation with an overview of the current state of the Nigerian economy.
So let me start with the socio-economic context and our present reality, which is really that our economy is not growing fast enough. Over the past 10 years, if you look at the growth rate, the average is slightly under 2%. In a country where the population growth rate is close to 3%. So what that means is every single day that we sleep and wake up, we have more poor people than the previous day. We cannot afford for that to continue. Inflation rate is high, and so is unemployment. We have widespread poverty. And it doesn't matter how you do the calculation, whether you do income poverty or whether you do multidimensional poverty, the numbers are humongous. More than half of our population are multidimensionally poor. And the things they're asking for to get out of poverty is not going to the moon, it's not rocket science. They just want clean water, they want basic education, they want basic health care, and they want standard of living that is decent. Our revenue is low, and our public debt is high. And what is even more concerning is the cost of servicing the debt as a ratio of our revenue. Then we have declining investments. whether you're looking at foreign portfolio investment, whether you're looking at foreign direct investment, they haven't been the numbers we would like them to be. For 2022, foreign direct investment was under $1 billion. That sounds like a number that you need for one project, not what you need for a whole country of over 200 million people for a whole year. We know within the global space, investable funds are in the region of $15 to $17 trillion. So if you just do the calculation of Nigeria's population as a fraction of the world's population, you say, what should we attract? If you take it a notch higher, you say, well, but this is the market where things should be happening. So which means our share of the global investable funds should actually be higher than the average for the globe.
So what should the future look like?
So the next thing is, where do we need to be? Now that we've painted a picture of our current reality, how we got there, where do we need to be? So I've just prepared a slide, just one slide there to tell the story. And this is looking at South Africa, which is, I think is the second, between them and Egypt. Sometimes you don't know where they are. I think it's the second largest economy in Africa. And the last fiscal year, 2022, South Africa collected, and just pay attention to this, 78.2 trillion naira equivalent from taxes. 78.2 trillion. Nigeria, across all levels of government and all revenue agencies, collected 15 trillion. Now, in fact, the amount that South Africa collected from personal income tax alone was 27 trillion, and that was more than the entire amount we collected in Nigeria from all tax heads. From VAT, they collected 19.5 trillion. From corporate income tax, they collected 16 trillion. Each of those three taxes individually was more than our entire collection. And this is a larger economy, right? It's barely 60 million people in South Africa, 2022. Where we need to be is to set South Africa as our minimum standard, that we should lead Africa. So if we can set South Africa as our minimum standard, both in terms of the quality of the reporting, most time I look at their tax reports and revenue report, and I feel like I should just donate some money to them because it's so robust and transparent, and they even got a global award as the best, I think about 4 or 5 years ago. So it's a good benchmark to focus on. How do we get there? The mandate of this committee is fiscal policy and tax reform. So how do we get there? So the first thing, in my view, is to acknowledge that we have challenges. And I think that's exactly what Mr. President has demonstrated by saying, you guys should come and help us. The second bucket of this, how we get there, is designing the solution. Once we've acknowledged that there's a problem, we design the solution to them. In doing so, we have to make our objectives to be crystal clear so everybody is sure about where we're going. Our design for the solution must be data-driven and evidence-based. And also, we have to look at the impact assessments. So both in terms of the outcome. So if this impact, which one will most impact our people positively within the shortest possible time, requiring the least possible resources, right? Those benchmarks are the things we work with. So you may come up with a very brilliant idea, but it's almost impossible to implement. We'll put it down in terms of priorities. And then we have to, and that we've done already, we have diverse expertise in the room. We need to ensure that there's sufficient stakeholder engagement and public input. So the next one for the deliverable and outcome is we're looking at the Office of Tax Ombudsman and Office of Tax Simplification. And I'll tell you why this is important. Today, you know, many of our people will say we are hustling, right? Even though they say hustling get level. But people who are really hustling, right? You see the person just trying to make a decent living. Sometimes they barely can make 2,000 naira a day. Now, it is very unlikely they will understand their tax obligations. It is impossible for them to hire any consultant. Now, somebody shows up and says, Oga, madam, you are owing government 2 million naira. What do you think they will do? First, they will be aggressive. And by the time they close down, lock up their shop, they took some of their wares, they start begging, Oga, please. I cannot, my kids have not eaten, we've not paid school fees. After negotiating 2 million, they say, okay, madam, this is an account, pay 300 to this one, 300,000. Then this government account, pay 200 and we can help you. And madam will pay and then say, thank you. We're being unfair to our most vulnerable people. Maybe that person should not have paid anything. But who is helping them? The country should help them. So this Office of Tax Ombudsman will be funded by government to take care of those people. And we're going to have a properly structured process so that it's manageable. If they are wrong, of course, it's not to defend them. It's just to make sure that they get fairness and justice. And then that same office will wake up every single day and say, what else can we improve to simplify within our fiscal system and taxation space, right? Then another outcome, number 9, is we want to be able to produce model templates for subnational. So Kaduna State harmonized their tax code. They have only one code today, whether it's state tax or local government, it's one code. And there's no cash payments. So it was not surprising that Kaduna increased their revenue by over 300% within just 4 to 5 years. Ondo State also did the same thing. My brother is there. So what we want to do is to come up with those models so that once the subnationals agree, they just take our template and adopt it. Or they can say, well, we want to adapt, so we change a few things, which is okay, but they will not be starting from zero. Because at the end of the day, our success cannot be measured by what we do only at the center. It has to cut across. When the life of a Nigerian is difficult, they don't care whether it's local government or state or federal. They just know Nigeria is not working for them.
Call it agenda setting and you will not be wrong. And once again, on envisaged outcomes, the Honorable Minister of Finance.
No, I think Nigerians should expect a new Nigeria, a Nigeria that is better for all, a Nigeria where the economy grows, jobs are created, and poverty is reduced, and including the young people in particular. When we talk about growth, we're talking about inclusive growth. I think that's the Nigeria that Mr. President wants to create for all Nigerians, but for young Nigerians in particular.
Opening formalities over, the committee resumed work in earnest. Again, Mr. Oyedele outlined the challenges facing the Nigerian tax system.
The first one is fiscal challenges around revenue mobilization, quality of spending, and sustainable debt management. The second one is weak coordination between fiscal and other economic policies within and across tiers of government. The third one is multiplicity of taxes and multiple revenue collection agencies. The fourth one is poor accountability and inability to demonstrate efficient utilization of government revenue for commensurate fiscal exchange. Number 5 is largely fragmented, rudimentary, and complex tax system, adding to business risk and uncertainties. Number 6 is low tax morale and high prevalence of tax evasion. Number 7 is high cost of revenue administration on the part of government and excessive burden of compliance on the part of taxpayers. And the last but not the least is growing tax expenditure, waivers here, incentive there, tax break there, and erosion of the country's tax base, as well as arbitrary waivers. So if anybody then asks, what is the purpose of what we are trying to do? So the statement of purpose and direction, based on the directive from Mr. President, is for this committee to help define and shape the fiscal and tax direction for Nigeria.
Quite a mandate, and we shall be sharing with you fuller details of what transpired at this all-important inaugural meeting of the Presidential Committee on Fiscal Policy and Tax Reforms. It's a Tax Matters exclusive. Stay tuned with Tax Matters. The committee has since been received in audience by Vice President Kashim Shettima, who is the chairman of the National Economic Council. We move on. At the CITN, a new leadership is in place. Barrister Samuel Amuliyi was installed as the 16th president of the CITN on Saturday, 16th June 2023. Barrister Amuliyi is also a member of the Presidential Committee on Fiscal Policy and Tax Reforms. We sat down for an interview with Mr. Amuliyi to find out what his plans are for his 2-year tenure. As you'll find out, the interview that we're about to share with you contains some perspectives on matters relating to the work of the committee in particular and tax administration in Nigeria in general. Barrister Amuliyi, thank you for joining us on Tax Matters.
Thank you very much.
Let us begin by congratulating you on your assumption of office as the 16th president of the CITN. Now, let's begin this way. How has the journey been to this glorious stage of your career as a tax practitioner?
Thank you very much. It's been quite rewarding, fulfilling, and I can only thank God who has been with me all through the journey so far. I've learned a lot of things along the way. I've been trained by the Institute, and I'm grateful to my colleagues who have also supported me up to this moment.
Now, with your expertise and experience, what are you bringing to the table as the president, the 16th president of the Institute?
Well, I tell you, in a way, my job is easy. CITN has a roadmap of what we tend to achieve. First of all, we are guided by the charter that set up the Institute. And the number one objective on that charter has to do with the setting of knowledge required for anybody who wants to practice taxation in the country. If you want to be a tax professional, you must have the benchmark, minimum benchmark, you must not go below. I need to keep my eyes on this because we are a knowledge-based institute. We need to keep our eyes on the ball. And I tell you, taxation can be very technical. Some people may not know this. It can be very technical. And what you don't know or what you don't have, you can't give. So for those who are coming in, the students, we keep on reviewing the syllabus to meet international standards and to ensure that they are on top of the game. They can stand the rigor of being tax professional. The founding fathers, they have done very well. So we need to improve on this by making sure that our leaders are top-notch. Foremost is to ensure that we assist the government. The immediate past government repeated over the time that the problem was revenue. So they needed money. And for quite some time, NFPC was not taking anything to fact accounts. So who came to the rescue? Federal Inland Revenue Service. So we need to look into, first of all, appreciate Federal Inland Revenue Service for coming to the rescue of the country when it matters most. But are we there yet? Is FRS there yet? Is everybody in the tax family across Nigeria, are we there yet? No, we are not there. So we need to ensure that we use this opportunity to assist the government as to how we can do better, how we can increase our tax to GDP ratio. The recent figure of about 10% to GDP is quite sharing, a kind of sharing news for us. But we can do better because that is still below the West African average. But at least we are happy we have moved from 5 or 6% to 10%. We are moving at the right trajectory. But we need to let the new government know that we can solve a lot of things. Without revenue, there's nothing you can do. Repaying your debt with 96% of your revenue is suicidal. If it's a company, you can't survive. So we need to reverse the ratio and make sure that government has a lot of money because the debt is constant. You need to repay. Otherwise, you lose your integrity across the world, and that Nigeria cannot afford to do. So what do? We advise the government on how this revenue challenge can be overcome. And I tell you, we cannot go anywhere unless we resolve the trust deficit. The moment Nigerians can trust you, they put their money in your hand, you get voluntary compliance. If they cannot trust you, you need to do enforcement before you can collect revenue. And you know that there's a cost to enforcement. But once you have a larger percentage of the populace complying voluntarily, then you are good to go.
Time, oh time, it's time to go. The concluding part of this interview with Barrister Abuja will come to you in the next episode of Tax Matters. Thank you for watching. Remember, for information and education on taxation, Tax Matters is the program to watch. See you next week.